So thank you everybody for joining us today. So we're going to be going over quite a bit of information pertaining to taxes and estate planning, and this can be an overwhelming topic for some, especially depending on how large your estate may be or the complexity of your family situation. So if we don't have a chance to get to your questions today, please don't hesitate to reach out to us. At Kopenberger, we can do appointments. And then if you're needing to be put in contact with Mike, we'll have his information in our chat, or you can reach out to our office and we can provide that for you as well. So for those of you who don't know me, my name is Victoria. I am one of the estate planning attorneys with Kopenberger and Kopenberger. Kopenberger has been around for over 42 years now, serving pretty much the entirety of California. And then I became an attorney with them just over 3 years ago and primarily work in our Northern California office in San Jose. And then I also travel to our Sacramento and Santa Cruz offices as well. So if you ever are meeting with me, I'm very excited to get to meet with you. But if you are in one of our more Southern California locations, I would be happy to connect you with one of our attorneys there. So one of the first things we're going to go through are just basic trust provisions. So essentially going through how can your trust protect you from estate taxes. So if you already have a trust, or maybe you don't, but especially if you do have a trust, one of the biggest advantages to having a trust is the fact that you can do tax planning within it. So we're going to cover that today. We'll also talk about how you can reduce the size of your taxable estate. So I know for some of you that is a concern of ensuring that, okay, what if my trust isn't enough? Are there other ways that I can protect my estate from being taxed unnecessarily? A big one that's a topic right now is how can you protect your home from increased taxes, both property taxes, but also protecting it from capital gains taxes. This is really going to be talking about the effects of Proposition 19. And then how can you protect your estate and beneficiaries from any outside predators, whether that be a ex-spouse, whether that be taxes. We'll go through and talk about how you can do multi-generational protection planning. So first and foremost, let's talk about how your estate plan or your trust itself can actually help protect from taxes. So for so many of our clients, when they first come to us, they're starting with a plan that really doesn't need to worry about estate taxes because they may just be starting out in a career, they're just starting a family, they haven't gotten to the point that they are as concerned about taxes. It also is the sooner you do an estate plan, the less likely you are thinking about what happens if you die, because you're probably younger at that point. So as time goes on, taxes may start to become more and more of a concern, especially when it comes to what happens when I pass away. So one of the things we absolutely recommend to anybody with a trust is that you have it reviewed every 3 to 5 years. Often 3 to 5 years, there's not going to be a whole lot of changes that are needed. However, there are times that within that 3 to 5 years, you have now hit a point that we need to be talking about advanced tax planning. And often those are in the forms of AB or ABC trusts. Now, these trusts are great for tax planning, but they're also an ideal way to protect in the event you have a blended family. There are different ways that this can protect, especially with blended families, the spouse's respective children. So if you have a blended family and you're not sure if you have one of these types of trusts, or if you don't know if you should have one of them, please come and talk to us. A lot of times the people with blended families who need these are the ones where they want different distributions to their respective children. So we can absolutely customize a plan to make sure that both sides of the family are protected and that your respective wishes are captured. One of the biggest advantages, though, is that it can protect 50% or more, if you have an ABC trust, of your estate from remarriage, taxes, creditors, and lawsuits. So we're going to focus today on the tax component. So one of the things that people often don't realize is that with an AB trust, you can actually double the estate tax exemption that your estate qualifies for. So today that exemption is over $12 million, and most of us are not going to be concerned about doubling or tripling that exemption. However, that is a fluctuating number, and Mike's going to touch on that a bit more towards the latter half of this presentation. But knowing that that is a fluctuating number, and especially if you own property here in California, you may all of a sudden have a tax issue that you didn't have when you first set up your estate plan. So these are trusts that can help either reduce or completely eliminate taxes on your estate, which for us, we very much look at the estate that you have built is yours. You should not have to give it back to the government with unnecessary taxes. Now, I mentioned this with the blended families, but all of our trusts are customized because we truly think that planning is unique to your needs. There is not a one-size-fits-all situation. And so every client that comes in and has their own trust, it really is their own. It is not going to look identical to anybody else's. These trusts also can protect if the surviving spouse remarries. So I mentioned that it can protect 50% or more of the estate from remarriage. So this can be a large concern that, well, what if I pass and my spouse remarries and the person they marry wants to take all of the money or wants to give it to their children, and now my surviving spouse cuts out my kids? How do I protect them? These trusts are phenomenal ways to do that, because even if you're not in a blended family, it doesn't mean the surviving spouse won't become part of someone else's family once you pass away. And I know these can be really hard things to comprehend, and a lot of times we say that would never happen. The problem is it can. And so if this is a concern for you, absolutely come and talk to us, and we can help you address the best way to protect yourself, your spouse, and any of your children or future generations. Now, we're also going to talk today a bit about charitable planning. So one of the ways that you can help ensure that your estate does not hit the estate tax level where a tax would actually be owed is by having charitable beneficiaries within your trust. The advantage here is multifold. One, the old saying is true that it is better to give than receive. There are a lot of psychology tests and research and things done that show, generally speaking, giving makes people happier than receiving. So that, just from a psychological standpoint, can be a benefit. But it also can help reduce your estate taxes and your taxable estate. Because the more you give to charity, it actually ultimately means the more money is in your pocket, which means you can give it to your other beneficiaries or heirs. But then there is also that element that we'll talk about at the very end of the presentation that deals with your legacy. One of the big things we believe in here, and actually the reason our founder started this firm, is we believe that your legacy matters. And so a lot of times for our clients, part of the legacy that they want to leave is dealing with leaving charitable gifts to their church, maybe their university, or a favorite foundation or charity. And so if this speaks to you and to your heart, and you don't have it in your trust, or you want to make updates to who is in your trust, please come and talk to us. Now, there are a few other ways that you can help reduce your estate. One of them is in asset-based giving. There are non-cash gifts or asset-based giving that can actually help reduce the size of your estate. The non-cash gift is something of value that the IRS does not actually consider cash. This can be non-material assets like stocks and bonds. It can be machinery, books, and even computers. So if you're looking to give things to charities, this can not only benefit the charity, but it can have a direct tax benefit for you and for your estate. Now, if you have questions on this, this is where we work very closely with someone like Mike, because he's able to help us from the standpoint of the CPA side. What do you need to show the IRS to make sure that this non-cash gift is actually going to have the advantages you wanted it to? Now, one of the other pieces is talking about actually investing, so doing charitable investments. There are investments out there that can actually offer you, as the donor, payments over years of your life and tax breaks for those years, with the balance ultimately going to the charity at your passing. Now, this can be done in what is called a charitable trust, or it can be done in an actual investment. Then there's other investments that can offer the charity payments over years and be returned to you at the end of the term you've set, with tax breaks during and after your life. If you have any more questions on this, I'm not going to go too far because this is an extremely extensive topic. But if you have any questions on the estate plan and the charitable trust component, please let us know, because our wonderful attorney, Sunny Boren, loves to help people with setting up charitable remainder trusts. And if you have questions on any form of investments, please let us know, because we can put you in touch with our financial partners at Lifestyle Financial. If you already work with them, you can absolutely speak with them, of course, about incorporating charitable giving into your financial plan. But if you don't have someone you already work with, or you just need a second opinion and you don't have their information, please let us know and we'd be happy to put you in touch. Now, one of the biggest things that is being talked about right now is Proposition 19. So Proposition 19 really affected the way that we look at planning when it comes to your real property. So prior to Proposition 19, there was no requirement that a child who inherits a residence had to change or think of it, or claim it, I should say, as their primary residence. Unfortunately, Proposition 19 changed that and now says the only property that can qualify to keep your property taxes is your primary residence, only if the child who inherits it considers it their primary residence. So this has quite a few ramifications. If you only have one child, then it's really up to them. Do I want to live in mom and dad's home? Do I want to sell it? Do I want to rent it? They have more control and choice. But the problem is, if you have more than one child and you gift a home equally, if let's say you have 3 kids and only one wants to own and claim it, now you have what is called a child-to-child transfer, because 2 of the 3 are giving up their interest to the one. And so then 2/3 of that property can be reassessed, and those property taxes can be raised to the current value. Depending on when you purchased your home, that could be a drastic difference. We have clients that are still paying only about $3,000 a year for their property taxes, but based on what their home would be, that could skyrocket to about $18,000 or more. So this really could be a significant impact for your kids. The great news is we do have language within our trusts that can still allow your kids to maximize keeping your property tax basis. And that is by using what is called the right of first refusal. This right of first refusal essentially gives one of your children the ability to purchase the home from your estate. So then it still qualifies as a parent-to-child transfer. Now, if they choose to do so, and again, you have to name one and then the other. If they choose to do so, they have to compensate their siblings for any value that the siblings are not getting in the actual home. That way, everything is still equitable and equal. But it again allows then the one child to determine, do I want to live in and claim mom and dad's home as my primary residence? And if they say yes, and they compensate their siblings, they can then avoid the property tax reassessment. So this is language that we have been including very significantly in much more of our trusts at this point. So if you have a trust that is older than, at this point, 3 years old, and you have not had it reviewed, come in and talk to us, because the likely situation is you did not have this language included because you really didn't need to worry about it when you first set up your trust. But it is a good time to come and talk about this, because unfortunately we are seeing quite a few properties have to get reassessed as a result of Proposition 19. Now, one of the other questions we often get from clients is, can I just transfer my property to my kids now? What are the consequences? So with this, we're going to look at not only the property tax consequence, but we're also going to look at the capital gains consequence. Now, if your child never sells that property, you transfer it to them, they never sell it, it goes on to your grandchildren, and for generations to come, it keeps transferring. We're not really then going to be worried about capital gains. But the thing that is often overlooked is that if you can wait to transfer your property to your children until after you've passed away and have it transfer through a trust, that home that you have gets a new value. So let me give you an example on this. Let's say mom and dad bought the house back in 1964. And at the time they purchased it, that property was only $20,000, which we've had a few people who were able to buy their homes for $20,000 around that time. But now the home is worth $1.5 million because, again, they live in California, and that is also a pretty common trajectory that we're seeing when it comes to value. If their kids inherit that property at 1.5 million after both parents have passed, and they turn around and sell the home for 1.5, they can avoid capital gains. If you transfer it ahead of time and you transfer it at 1 million, and now they're selling it later for 1.5, now they're going to have a capital gains issue. So that is something to absolutely consider when you're thinking about when to transfer property to kids. Now, there's a lot more that goes into that, and each situation is going to vary to a degree. And this is where, again, we rely on someone like Mike to help our clients with the pieces that we don't do, that really is dealing specifically with the IRS. But absolutely, if this is a concern for you, or you're wondering, when can I do something and how do I maximize the benefits, please reach out to us or to Mike or both to make sure that we're really maximizing your tax advantages. Now, one of the other components that we're looking at with your estate plan is multi-generational protection. One of the ways that we do this is by installing into your trust what is called a generation skipping trust or a lifetime protection trust. So what this means is that rather than your children inheriting assets just to their person as an individual, they would actually inherit through your trust into a protective trust of their own. Now, for some kids, it's not appropriate for them to manage their own inheritance. And so one of the advantages to a protective trust is you can install someone else to manage it for them. But for those children who can manage it, they're able to still maintain and manage their own inheritance, but their inheritance now has a wall of protection around it. This will protect their inheritance from creditors, lawsuits, bankruptcy, the IRS, and even a divorcing spouse. So if your child is ever going through a divorce, that now ex-spouse cannot have any interest in their inheritance. So it ensures that it stays within your family. But then from a tax standpoint, it also has tax advantages for your grandchildren. What that means is anything left in that trust at the end of your child's lifetime will pass to your grandchildren free of tax. So not only are you protecting yourself and your spouse, you're protecting your children, now you're also doing multi-generational tax protection planning. And so your estate plan can be all-encompassing when it comes to tax protection. So again, if when you started taxes really weren't a concern, or your estate has changed drastically since you started, or you haven't seen us in the last 3 to 5 years, please don't hesitate to come in. There are a lot of things that are happening when it comes to tax laws in the last couple years, and we're projecting there are likely going to be more in the next few. And so this is something that will likely have an impact on almost everyone's estate. So if you have any questions, or again, haven't had an update or a review, now is definitely the time to get that done. All right, now that was quite a bit of information that I covered relatively quickly. And so again, if you have any questions, please let me know. If you have any further questions on any of the things that we talked about, or you have specific questions to your situation, we'll have our information up at the end so that you can reach out to us directly and set up a consultation. Now, one of the questions that came up during that section is Proposition 19 only for California? And yep, Mike, you got it. It is only relating to California property. So if you have property outside of California, then you really don't need to be concerned about Proposition 19. If you have property in California, this is absolutely something to be concerned about. We do have other webinars on our website at kopenberger.com under the resources tab. So if you want to learn more about Proposition 19 specifically, you can watch that, or you can set up a consultation with us so that we can go through it with you also. All right. So now we're going to get into specialty planning. So this is where, again, we're diving a little bit further beyond just your trust component, but we're now getting more into the specialized planning that can be done. One of the questions is, how does my special needs plan for my child impact my estate and taxes? So if you have a special needs child, not only are you concerned about protecting them, we'll also look at how it can have some tax advantages or protection advantages. How are your retirement plans affected by taxes today? So again, I mentioned there were some tax laws that have come down the pike in the last couple years, and one of them does affect retirement plans. We'll go over the specialized estate planning that's available to you, and really importantly, why working with a qualified CPA is so vitally important. So let's first talk about special needs planning. So if you have a special needs child, one of likely the biggest concerns you have is, how do I protect my child if they do have special needs? There are two different types of special needs plans that we primarily work with. One is going actually into your estate plan itself. The other is a trust that is actually set up independently, and it essentially serves as its own document. When we're looking at, is one of these going to be necessary, we're looking at, is your child going to ever be self-sufficient as an adult? And do they have government benefits, or will they need government benefits? The government benefits component is often a misunderstood piece when it comes to a child's inheritance. I have had countless special needs parents come in and tell me they aren't going to leave their special needs child an inheritance. They'll leave it to the sibling, who will then use it to take care of their special needs child, because they don't want their child to lose government benefits. The great thing about a special needs trust, regardless of which one you end up doing, is that your child, the special needs child, can still receive an inheritance that is managed by someone else, but it allows them to receive it and not lose their government benefits. The reason I so strongly encourage you to do it this way, rather than having it funnel through a sibling, is two reasons. One, the sibling is not necessarily going to understand special needs rules when it comes to government benefits, and they could potentially disqualify, without intending to, the special needs child based on how they're using the money, or if they ever gave the child a lump sum or something else that the government could use to disqualify them. But the other situation, and frankly heartbreaking situation, that I have seen quite a few times, unfortunately, is everybody has good intentions when they're setting this up. And a lot of times siblings will say, of course, I'll take care of them. You don't have to worry. Parents pass and the money goes to the sibling who's going to manage it. Unfortunately, when that sibling has that money in their hands, they often look at it as theirs. And I have seen a lot of situations where either the money is not at all used for the special needs sibling, or the one who can manage it is so strict that it's really not benefiting the special needs child. Because again, the one who can manage it, there is an interesting psychological thing that happens when you have that money in your hands, where now you think of it as yours. And so by setting up a special needs trust, you can avoid that scenario, because there are requirements for the special needs trust to actually be used for your kid. All right. Now, I mentioned that there are two types that we mainly deal with. The one that goes in the trust, I'm not going to really talk about as much today. I'm more going to focus on the one that is considered a standalone special needs trust. This standalone special needs trust allows you to build that team of advocates, and it allows for planning that's going to take into consideration inflation, taxes, and life insurance, and whether your child is still going to need care as an elderly adult. But from a tax standpoint, the standalone trust is fantastic for other family members. With the standalone trust, other family can actually donate to it and have those donations be treated as a gift, which, if they are concerned about the size of their taxable estate, allows them to gift into this trust, so that not only does your special needs child have the benefit, but it has tax benefits then for other family members. Now, the other piece is not so much tax related, but it is benefit related. One of the things we unfortunately are seeing more and more and more is the need for, at some point, long-term skilled nursing or some form of advanced health care. And one of the big concerns is, how the heck do I pay for this? It has become so expensive for every single month. I don't know how I'm going to afford this. So one of the trusts that we actually offer, we call our long-term care trust or Medi-Cal trust. And essentially with this trust, what it is looking to do is protect you and your estate. What that means is we can actually protect your estate and make it appear that you really have no assets, which allows you to not only keep your estate, but also then qualify for Medi-Cal. Now, if you don't have this trust or you have further questions on it, please reach out. But one of the things and how this ties to the special needs trust is that any asset within the special needs trust that has been gifted to them by you or other family can actually protect your Medi-Cal eligibility, because the assets within that special needs trust, even if you are the one managing it on that child's behalf, are not counted against you. So there's multiple ways then that, again, this can benefit your child, but also benefit you and your other family. I'm going to pause and just look really quickly through some of the questions. One of the questions is that I mentioned that there's a trust that can protect your children and grandchildren, even if there is a divorce. Does this apply to California, even though it is a community property state? Yes. The reason is, it's multifold, frankly, but the simplest way to look at it is an inheritance in California is considered separate property. Now that's great on its face. So why would you then need a trust to protect it if it's already separate property and it couldn't be taken away from them if they ever got divorced? The issue with it going just directly to your child is that in more cases than not, at some point or another, they what's called commingle the asset with the spouse. So if they put that inheritance into a joint bank account, now it is falling under community property. With the trust we set up for them, because it is an actual vehicle that the assets go into and your child can manage it, they generally speaking are not going to be able to ever put a spouse into that account, which keeps it separate property and so then does not fall under community property states. All right. So, and then the other questions dealing with, actually our law firm will be speaking at a church in San Diego this September. So can you work with an attorney then? Absolutely. So you don't have to come in now. If we're going to be speaking in your area and you would rather speak to us then or gather more information, or if you've worked with one of our attorneys before and you want to keep working with them, absolutely. There's no requirement that you have to sign up right after this webinar. All right. So one of the other big things that changed dealt with your retirement accounts. One of the ways that this changed was by the Secure Act. This is the biggest way it changed. So the Secure Act essentially changed planning options for beneficiary designated accounts dealing with retirement. So if you have a 401k or an IRA, do be aware that when your child inherits that, they now have to withdraw the funds within 10 years after your passing. So this can have some significant tax ramifications on your children. So this is where talking with us, with Mike, or with Lifestyle Financial, or whoever you use as a CPA or financial advisor is really worth it, because knowing how you should plan at this point can have drastic tax implications on your children, both positive or negative. So again, if you are sitting here with a 401k or an IRA and have not talked with anybody about what the Secure Act does and the consequences, or what you can do to hopefully avoid taxes, now is definitely the time to start planning. Now, the other note though here is that if you make a charity or organization the beneficiary, this can offset the taxes due. So again, if you're looking at how do I avoid taxes on these accounts and you have not spoken with someone, I really urge you to not wait, because if you are someone like my father, You were raised very much with the mindset that IRAs and Roth or IRAs and 401ks were the best ways to invest. Unfortunately, this has now changed. And so thankfully, he has been talking with Lifestyle Financial and his CPA to figure out what are the options that I can do now to try to mitigate taxes for when he passes and I inherit any of those retirement accounts. All right. So getting into some specialty planning, and I'm going to go over this fairly quickly because these are incredibly detailed trusts. But essentially what you're seeing on the screen is that you have a significant number of options if you are concerned about taxes and reducing your taxable estate. Depending on where your wealth is at, you may not care about any of these things right now, but do be aware, regardless of where your estate at is today, these are again things that fluctuate as life goes on and as the government changes hands. So if you need more specialty planning, and the AB or ABC trust are still not going to be enough for you, this is where come and talk to us and to our tax attorney, Sunny Boren, because from a estate plan side, she has endless options for you. All right, now I'm going to hand it over to Mike. And really today, what we're focusing on is why should you use a qualified CPA? I emphasize the word qualified because there are plenty of CPAs in the world, but when it comes to trusts and estate taxes, you really need a CPA who actually understands it. I actually got to work with Mike on my grandma's estate tax return. And when I went into it, I expected to pay the estate to pay anywhere from $40,000 to $60,000 of estate taxes. And I frankly don't understand it, but by some magic miracle, Mike was able to reduce that to zero. Now, I'm not saying he can do that in every single situation. I'm not saying that every case is going to be the same, but what that 100% told me is he understands estates and estate taxes. And so that is why we really value and encourage you to work with someone who's really qualified when it comes to your trust and your family. So I'm now going to turn it over to Mike.
Thank you, Victoria. Hi, everybody. I'm Mike Fuji. I'm a tax partner at Johansson Yao. I'm based in Campbell, California, which is right next door to San Jose. We used to be in downtown, but we recently moved, or I guess it's been a couple years now, but we moved to Campbell, and we've been here since 2020. The topics I'm going to go over today are more on the practical side of estate and trust taxation, and kind of go over the overview of how you're going to need to file or handle the trust administration and estate administration, and so you remain in compliance. So the topics or the questions I'm going to try to answer for you at a high level are: how do you know if your trust needs to file a tax return? That would be number one. Number two is how the income of the trust is going to be taxed. And then the third is who's responsible for paying the tax. And finally, when are those trust taxes due? You want to make sure that if you are the lucky one in your family that gets to be the administrator of the trust, or the trustee of the trust that's been set up, you have all these answers for each of these questions so that you can help make sure that you're taking care of all your obligations as the trustee. Next slide, please. So I'm going to go over these few types of trusts. As far as in the tax world, these are the types that we're primarily looking at in trying to make sure that these are the ones that clients come in and need help determining what their obligations are. So the easiest one, the first one, is a grantor trust. These are typically, the simple ones that family living trusts. These are where, you create a trust and you have control over it. You can revoke the trust. You can make amendments to the trust. So these are where you still have all the power over the assets. And for that reason, the grantor trusts are typically just charged or taxed to the individual trustee and who is also the grantor and beneficiary. So they are the ones that are going to be paying all the tax. It's reported on their own individual tax return generally. Um, there are times where you may find a grantor trust that they've created a tax ID number, a separate tax ID number for the trust. And in those circumstances, you would file an information return where you report the income and any potential deductions. And then you get what's called a trustee letter, and that, or a grantor letter, which would help you report the income and deductions on your personal income tax return. The next type of trust is a simple trust, and the simple trust is one in which the income is distributed in full to the beneficiaries of the trust each year, at least annually. And so this is where if the trust had a bunch of investment accounts, the dividends and interest would be distributed to each of the beneficiaries, and that would be just on an ongoing basis. It would be distributed out to the beneficiaries, and the beneficiaries would receive a K-1, which is a report that goes to each of the beneficiaries that receive a distribution, and it tells them how much of that distribution is income that they need to report on their personal tax returns. One thing to point out is that capital gains are typically considered part of the corpus or principal of the trust. And so those are not considered part of the distributable net income from the trust, which means that it wouldn't be taxable to the individuals. It would remain as part of the trust income. The next type of trust is a complex trust, and this is where you would typically see more of the trust income potentially being taxed at the trust level rather than being distributed out to the individual beneficiaries. And so for these complex trusts, it could be all or none of the income is distributed out, or it could be just a portion of the income. And based on how much is distributed, you would allocate it to the various sources of income, whether it's dividends, interest, any other type of income that may come into the trust or be allocated to the trust that would be distributed out to the beneficiaries. And again, a K-1 would be issued with the tax return for the individuals to be able to report the appropriate amount of income on their personal returns. And any remaining income in the trust would be taxed at the trust level, while the amount that's distributed out would be taxed at the individual level. And these are things that we would determine by reviewing the trust documents to make sure that we're evaluating how the distributions are to be made and whether the income should be distributed out to the beneficiaries or held within the trust. And that's where we typically would, if we have a copy of the trust, we can usually read through and determine that. Sometimes we'll reach out to the attorneys that we work with. Victoria has been great in talking with some of my clients and some of our mutual clients, where we're able to determine the proper treatment and make sure that everything is allocated appropriately. And the final trust that I wanted to mention was an administrative trust. This is a trust that's created upon the death of an individual. And this is where the individual may have some assets that are still producing income, and it needs to be reported before they're distributed out. And the administrative trust would handle that and help collect the income and pay out any expenses of the deceased taxpayer. So the person that's typically responsible for getting these tax returns filed and paying the taxes would be the trustee of the trust. Sometimes there's co-trustees. When I work with clients, typically I would have meetings with any of the trustees or co-trustees to make sure everybody's on the same page, make sure that we're all working together um, to get the correct information out to the beneficiaries, because that's one thing that you really want to be careful with is you don't want to be in a rush to close out the trust if you don't need to be, because there's potential if you over distribute and don't have enough cash remaining within the trust, you may need to go back out to the beneficiaries to try to collect some of the those distributions back, and that just leads to a lot of headaches and difficulties. So you want to work with the CPA, work with your attorneys early on, and make sure everything's straightened out from the beginning. And then as far as when the tax returns are due, the tax returns are going to be due um, April 15th, just like an individual return. But if you need to get an extension, you can get an extension, but it's only for 5.5 months rather than the 6 months that an individual return would be granted. So you would have until September 30th if you were to extend a trust return, and then you would have to file at that point. So in working on the trust tax returns, the typical documents that we would need in order to file a complete and accurate return would be all of the investment accounts, bank account statements, pass-through income, other income, rental activity income, and deductions. So all of these are going to be records that you would get a normal 1099 for or K1s. So the initial months of a year, you're going to be collecting these documents. You should retain them and also have the bank account statements and investment account statements ready for your CPA that you work with, so that you can ensure that you're going to have the returns completed correctly and accurately with all the information available to them. If there's a lot of inputs and inflows and outflows for the trust, I would recommend that you use an accounting software or something to help you track the ins and outs a little bit easier and classify them. An Excel spreadsheet could work, but that's typically going to be something where there's not a ton of transactions, and you can easily put that together through just bank statement activity and reconciliations. But if you have any questions about how to track the expenses and income for your trust, I'd be happy to talk with you and kind of give you potentially give you some templates or something to work on to help you with that. But as trustee, that's one of your responsibilities is record keeping and making sure that you have all of the information to complete the returns. Okay, so who is the trustee? The answer to most of these questions is going to be based on the trust documents and reading through the trust documents to make sure that if there's a trustee or a contingent trustee, that those are addressed in the agreement. And so what we do when we're first working with a new client, new trust, is we read through the trust agreement. If there's any question on anything, we would reach out to the attorney that created the trust documents and make sure that we have a full understanding of the line of succession. If there's any changes to anything, if there's been any amendments, we could potentially get those copies from the attorneys if they're not readily available. And then as far as the beneficiaries are also going to be listed out in the trust agreement. So we always have to rely on the trust documents to relay the proper information um, for us to report on the tax returns. The distributions, as I mentioned before, those are going to be reported on the K1s for the individuals. And so the trust return is going to run the entire activity for the trust. And then the distributions per beneficiary are going to be reported on the K1s that are distributed out to each individual beneficiary. And those will have the proper information for them to be able to report the income on their individual returns. And then when does the income get allocated to beneficiaries? That again is going to be something that is determined based on when money is distributed out to the beneficiaries or when assets are distributed to beneficiaries. And that's going to give us the indicators of how we need to allocate the income and benefit and distributions to each of those beneficiaries and what they're going to need to report on their individual returns and pay taxes on individually. So another thing I want to make sure I point out is that the income for some of these beneficiaries, it needs to be disclosed to them early on if there's potential for them to receive a K1 so that they're ready to receive some information from the trust. There's been a lot of circumstances where clients have come in and their beneficiaries of the trust have already filed their tax returns. Those individuals would then need to amend their returns. So making sure that you keep lines of communication open with the beneficiaries is really important as you're getting these items or the returns prepared for filing. So I have a question here. Did you say that capital gains from trust investments are not distributable to beneficiaries, so tax at high trust income tax rates? It depends. Typically, the capital gains are part of the corpus of the trust, and those would be taxed at the trust level. If it's a final year trust return, sometimes those can be distributed out to the individuals on their K1s. So the last point I wanted to touch on for today was the estate and gift taxation. A lot of you have probably heard about the annual gift tax exclusion. For 2022, it has increased to $16,000 per year per person. So this is where if you're giving cash gifts to an individual, this is where you can give 16,000 and there wouldn't be any gift tax implications. It wouldn't reduce your lifetime exclusion or anything like that. So a married couple could give their kids 32,000 and it wouldn't have any effect on that lifetime exclusion. So the lifetime estate tax exclusion, Victoria already touched on, but it's over $12 million at this point. But the future of the lifetime exclusion is kind of up in the air at this point. If nothing happens, it'll sunset in 2026 under current law, and it would reduce back down to between 5.5 million and 6 million in lifetime exclusion. And so the more recent tax proposals, have those numbers either coming before the sunset in 2026 and just reverting back sooner than later. Or the even more aggressive proposal is to reduce it down to 3.5 million. So this is something where, you know, things like portability are very important for estate tax planning purposes. If you have a situation where a married couple, one of the spouses passes away, you would definitely want to consider portability as an option in order to preserve some of that lifetime exclusion to be used at a future date, because you know the potential for the full lifetime estate tax exclusion to go down is pretty high right now. Um, but those are all, you know, speculation. We don't have any nothing set in stone, nothing's in concrete right now, other than it does sunset in 2026. So if no action is taken, the state tax exclusion is going to go down to 6 million, or 5.5 to 6 million. Okay. I think that's all I have. So I'll pass it back to Victoria.
Thank you. So there are a lot of facets when it comes to understanding taxes. So that's your own tax returns. That's what's called a fiduciary tax return, the estate tax return. Mike mentioned portability election and income taxes, and then of course, property taxes. All of that is to say, again, that taxes are generally more complicated than they appear for some people, and others understand how complicated they are. But the nice thing is getting to work with someone like Mike allows you to essentially know you're in great hands and can have someone where you can ask questions, and who in my situation was able to take the weight off of me having to figure it out and just ran with the ball and got it done. So if you have any questions, any further questions on taxes, or what you need to do, or what your fiduciary or trustee may need to do, or if you already are in the trustee position, absolutely reach out to Mike before you actually take any action. I'll reemphasize this at the end, but one of the best things that you can really remember is asking the question ahead of time will actually save you both monetarily, but also in time in the long run. Because we have seen way too many people, both in what we do and then with what Mike does, who they act because they're scared of missing a deadline, or they just want to get it done. And then they come to us and we go, okay, you actually needed to do X, Y, and Z, and now you're spending more time cleaning it up, and most likely spending significantly more money cleaning it up. So don't hesitate to ask questions. We encourage it. No question is too big or small, so do not hesitate to reach out. Now I'm going to wrap us up with talking a little bit more about your legacy. So I mentioned at the beginning that this firm was founded on the concept that every client who we have, that their legacy matters. And that legacy has multiple facets. But one of those facets is, what is a lasting financial legacy? So that's where we pull in people like Mike, or Financial Lifestyle. This way, or Lifestyle Financial, sorry. This is the way that we can help build your financial legacy. The legacy goes beyond that, and your estate plan can go beyond that. It can touch on your emotional legacy, what your morals and values are and that you want your family to maintain. You can actually establish what is called a family constitution, where family members essentially are agreeing to honor different morals and values. Memories and recipes are also part of a legacy. So all of these things can actually be encompassed within your estate plan. Now, your financial legacy can be captured with your estate plan, beneficiary accounts, your retirement planning, your just financial planning in general. But again, with all of these financial pieces, you want to make sure you're considering taxes and their impact. So like I mentioned with the Secure Act, putting money into your IRAs and 401ks may still be the best option, but it may not be that anymore. So it is important to make sure that you're considering these impacts with what you do with your finances. That emotional legacy can incorporate your family history, records, mementos, or one that really speaks to my heart are recipes. When my grandma passed, I got a stack of her recipes, and I absolutely love it because now I get to make things that she had made and that remind me of her. So it's absolutely something that, again, goes beyond just the financial piece. While the financial is incredibly important, it's also important to remember that your legacy can incorporate more than that if you want it to. And again, we believe your legacy matters. So if you have questions on how to leave a legacy, what does that look like? How can my estate plan actually help me? Why do I need to think about taxes when I'm thinking about my legacy? Any of those things, please come and talk to us, because again, we really do believe that every individual client's legacy matters. Now, when you're thinking about who you should refer to us, there's obviously a list of people, but ultimately it is anyone. Anyone who has questions on estate planning or taxes can go to us or to Mike, because we love to be able to educate you. It's why we do these webinars, so that you have access to qualified professionals and so that you're able to have yourselves, your loved ones, your charitable organizations, your friends, anybody that you would want, they have a resource where they can come to. So anybody who has questions, do not hesitate to have them reach out. Now I'm looking just over the Q&A really quickly. So as far as a step-up basis at the death of the last survivor with properties, so as far as the capital gains piece goes, that was where I talked about when the last spouse passes, it'll get a new appraised value. With the property reassessment, when it comes to taxes and property taxes, that is ultimately dependent on who's inheriting your property and how they're going to classify it. So if that didn't answer your question, I'll have our contact information up on the screen for you. So please reach out. I hope that did, but that can be a little bit more complex potentially. All right. So thank you everybody for taking time with us today. This was a wonderful webinar. I love getting to hear Mike speak on the CPA side of things. Again, taxes and estate planning are incredibly comprehensive. And so this was a lot of information that I know we threw at you in a fairly short amount of time. Again, if you have any questions on estate planning or taxes, ask first. It really is going to be cheaper and more time saving in the long run. Now, Mike's information was put into the chat at the beginning of or actually about the middle of the webinar. So if you want to reach out to him directly, there's his contact information. And then if you need to reach out to us or you need his information later, do not hesitate to contact us. One thing to note is if you do need a review of your trust, or you're a brand new client who you're just starting out and you're going, I don't know what I need and I need to talk to someone, anybody who is here today will actually get a free consultation with us. So if you have any of those questions, don't hesitate to set up one of those consultations. It will not charge you or cost you anything. Let me see. Where on the website will this full video be available? It'll be on copenbarger.com under the resources and then videos tab. So it'll be in there as soon as we have it done and edited. We'll put it up on our website. And again, we'll get a copy over to Mike so that he has it for his clients also. Now, if you do set up a consultation, just note if you have any estate planning documents, please bring them because we can review them. We will send you a questionnaire ahead of time. Please do complete that to the best of your abilities. I know for existing clients, it can seem very tedious and redundant, but we cannot thank you enough for completing it as much as possible. It actually helps us more than we can even say. And then, of course, any questions that you have. I'm going to leave the contact information up for a bit, but we are actually done for today. So again, thank you everybody for meeting with us or hanging out with us for about an hour. If you have any other questions, please let us know. Thank you.
Thank you, everyone.